Hello and welcome back to this channel. Today's lecture or today's small video is on international taxation. It's part 42 and we begin to talk about measures which states take against tax planning models, because naturally when you want to save taxes, you also need to know which tax saving models will no longer work, because there are already specific rules which spoil the fun. Good. If we want to get an overview about which anti or countermeasures can be expected, then we should to sum up again how tax saving models, which we already know, worked. There were two effects which push down the taxes. First, you created expense by contracts with other parts of your group, and that lowers the tax base. And sometimes you made sure that revenue was made or collected, but not by you, but by another company of your group, so that the inland couldn't tax it. So for countermeasures, you have immediately two principal ways. First, okay, you can say there is expense created, but you should not allow this expense to qualify for a deduction from the tax base. So the countermeasure would be, well, ignore this expense for the computation of the tax. Then it becomes irrelevant or unattractive. Another consequence will be such transactions will then even cause economic problems, because if you spend 100 and still have to pay taxes on the 100 as if they not existed, you do not only need 100 to fulfill your contract, but also, let's say, 140, because you have also to earn the necessary taxes. The second approach would be to say, yes, there is revenue, it's not your revenue, okay, however, we shall tax it nevertheless as if it were your revenue. So these two possibilities do you have as a state to counterattack tax saving models based on the two effects which we just listed up. Concerning the revenue stuff, it's naturally a question which technique you are going to use. So we can assume that a state, if it wants to make certain tax saving models unattractive, will probably follow one of these two approaches, or maybe even both of them, to make tax saving things unattractive. So let's first begin with the revenue aspect. Here we have a long history of anti-tax avoidance regimes, which goes back already to the 1960s and 1970s. And the underlying problem there is that a shareholder shifts revenue or sources of income to a foreign country and to a different person, so to a foreign company. And the situation which then arises is this. Let's say Mr. Rich is a taxpayer in the inland and has license fees from abroad, interest payments from abroad, rental payments from abroad, and all that is part of his worldwide income. So all that is taxed, and so he's taxed here on the basis of an income of 3.5 million. Now let's modify the situation. We have again Mr. Rich, we have the license fees, we have the interest payments, we have the rental income. And now Mr. Rich established a foreign company with 100% of the shares, and now hands over all his sources of income, at least for these three occasions, to that foreign company. Now in the future, the license fees, the interest payments, and the rental income go to the foreign company. So that when we look for the worldwide income of Mr. Rich himself, we find out there is no worldwide income left over. That's a bit drastic. However, this is how it works in principle. So when we tax Mr. Rich can say, I have no income anymore, so tax to be paid, no tax is left over. This model is favorable, advantageous, or positive whenever the tax paid by the foreign company is lower than the tax which Mr. Rich would have to pay. How now can a state make that construction useless? I already told you, well, the basic underlying idea is I have no revenue anymore, or it's the revenue of somebody else. So the traditional counter approach would be just to attack this basic thought. So let's imagine here is Mr. Rich, and Mr. Rich says, I'm now absolutely poor. No income anymore, so I live from welfare payments nearly, at least on paper. Now the fiscal office comes into play and says, indeed, we feel so sorry, we feel genuine pity for your situation, and well, our pity is so high that we cannot stand the feeling. We must do something about it and improve your situation, at least on paper. So let us just invent some additional income for you, because then you are no longer so poor as it looked just now. So we invent some additional income, let's say of 3.5 million in your case for you. So now you and we can feel better about the situation. You are not so poor anymore. Now Mr. Rich says, but you can't tax the foreign 3.5 million of my foreign company. That's not legal under international law. And so what you intend there doesn't work. Now the fiscal office said, yeah, but you didn't listen properly. We don't tax the foreign income of or the income of your foreign company. No, we would never dare to. We just tax an invented, non-existing amount, which has absolutely nothing to do with the income of your foreign company. And so we don't violate the right of any other state. We don't violate any rights of your company. So this invented income is just by coincidence only exactly as high as the income of your foreign company, but that doesn't matter. It's legally something different. Oh, so something else. And that's, to make that clear, we just call it additional fictitious income. We in this video and later will probably just make life simple by abbreviating that as AFI, additional fictitious income. In Germany, the term would be Hinzurechnungsbetrag, and everybody would abbreviate it as HZB. So basically, you use the fiction of civil law to say, without lying, that you are poor. And now we from the fiscal office use the fiction of tax law to say, without lying, that you are rich again. So we are clever, yes, because we are at least as clever as you were. So the nice trick, which makes it really clever, is now that you shifted money abroad to a foreign state, and so there might be problems with international law. However, by the way, we chose to tax it. You will never have any chance to find any international treaty which contradicts our behavior, because there will be never an international treaty in which we signed a clause what is going to happen with the taxation of non-existing income. So we do not violate any international treaty. And we are pretty sure that we also do not violate any other principle of international law, because no other state can ever complain about what we are doing. A non-existing income cannot have its origin in a foreign state. It comes from nowhere. And so no foreign state can ever complain that we violated their taxation rights in any way. So that's what makes our trick so clever. By the way, it was not our trick in Germany, it was a trick of the Americans in the 1960s or 70s. But other countries took it over. So the basic trick, which most fiscal administrations use when somebody shifted sources of income to a company in a low state tax jurisdiction, is that we just say we do not tax the income of the foreign company. That could violate international law, and it could violate some treaties which we have signed. So we just say we tax an invented income, which is called, let's say, additional fictitious income. We add it to your worldwide income if you are the shareholder of that company. And now this fictitious income, just by coincidence, by systematic coincidence, just has the same amount as that income which your foreign company has, and which probably was shifted there by a tax saving model. But officially, and that is the nice trick, the AFI is still something else. This is a trick. This is an unfair trick, naturally. Well, you, the taxpayer, also played a trick. You made yourself artificially poor by using fictions of civil law. What my company owns is not my property and not my income. So we make you artificially rich again with tricks of tax law. So both play tricks, and so the game is fair again. So that is how the basic logic of controlled foreign company taxation works. You need a certain sense of humor, naturally, to appreciate it in full. Now let us turn to some necessary consequences of such a CFC regime. So the shareholder of such a foreign company will have to pay taxes on that additional fictitious income because of his, her, or its participation. But as this AFI is fictitious, no money comes in. So you do not have the money to pay the taxes for it. And unfortunately, no fisc of the world accepts an offer as you tax fictitious income, so I pay this fictitious money. You need genuine money to pay. And so you will have to insist that your company pays out the available money in form of dividends so that you get enough money to pay the bill from the fiscal office. However, these dividends now are dividends, so they are actual income of you, the shareholder. And it's not the same, at least under formal aspects, as your AFI. So your fiscal office could say, if they stick to formalities, well, we tax the AFI. Now the dividends are something else. That was the plain underlying logic of the whole trick. And so we tax these dividends again. So you might end up with very interesting situations arising from that situation. Imagine Mr. Rich sits there and said, well, you want to tax my 3.5 million dividends again, but you did already tax them, so twice can't be. Now the fiscal office is just relaxed and says, well, you didn't just get the idea. We already taxed the AFI, which was 3.5 million. And as you certainly know, the whole trick was that the AFI is not the same as the foreign income of your company, and therefore it is also definitively not the same thing as the dividends which your foreign company pays out to you. So it's definitively legally possible to tax them again. And even the again would be wrong, because you never taxed them before the dividends. Now, naturally, this would be overdoing the trick and the fun a bit. And so the fiscal officer says, however, naturally, we see your point, 3.5 million taxed twice. Uh, so let us be very, very generous and abandon our principles that every income should be taxed. Let's just skip our tax claims on one of the two items or reduce it. Let's give you a discount to avoid that we fully tax these 3.5 million twice. We need a solution. We give you some relief. Such a relief or discount can now be given by declaring that amount of the dividend income as tax-free. So the idea would be you already paid for the AFI, so the dividend is tax-free. So you can, or you will always do it this way. You can do it in by different techniques. You could say a dividend coming from your foreign company is tax-free as far as and if you already paid an AFI for the underlying profit. Or by saying, these dividends are taxable and will be taxed, and later we give you as a compensation a free allowance or a deduction during the computation of your worldwide income, which immediately and completely compensate the tax effect of that dividend taxation. That's just a formal deviation. It's a question how you do it. The former situation or solution was plain and simple. The dividends were declared tax-free. That's the older German solution. Nowadays, Germany changed the technique and said, the dividend revenue will be regarded as your taxable income, and on a later stage in the computation of your worldwide income, we give you a compensating free allowance or deduction, which just annihilates the tax effect of the dividend taxation as far as the AFI was already taxed before. So that's highly complex. So let's think of an example. You are a shareholder and hold 100% of the shares of a foreign company in a tax oasis. Now, since this foreign company has had an income of 3.5 million, which was lowly taxed, you as the shareholder have been taxed on the AFI already, 3.5. Later you get a dividend of 3.5. So the solution might be the dividend will be either declared as tax-free with 3.5, or the dividend will be fully regarded as taxable income from capital, but later you get a free allowance or deduction at a later stage of 3.5 just to compensate from the previous AFI. A variant might be if you hold the shares within your business, then in Germany the share dividends would be part of your business income, so they become income from business. However, that would already trigger a tax exemption of 40% under the regular rules, so the free allowance to compensate for the impact of the further AFI taxation would then only be granted for the remaining 60% of the dividend amount, so 2.1 million in our case. That's in paragraph 11 of the AStG, the Foreign Relations Tax Act of Germany, the Außensteuergesetz. And naturally, in this case, this 2.1 will be deducted from your business income or your total taxable income. That's a question of taste of the legislator. So that's one idea. Now, another problem arises. If you shift your money to a foreign company in a foreign state, this other foreign state will also claim some taxes, probably not so much of taxes, otherwise you could not have gone there. However, there are taxes, and the question is, what do we do with them? Perhaps you want to have a relief. So at this point, the drama reaches its next stage. So Mr. Rich, for example, says, I already paid 10% corporation tax in the foreign country on my 3.5 million in the foreign country. And I want to get some relief against double taxation for that. Now the fiscal office seems to see that first a bit relaxed and enjoys the situation, because they could now say, So you, as a natural person, an individual, paid corporation tax. That's surprising and highly implausible, because you didn't pay it, yeah? You are not the foreign company. Your foreign company paid that tax. And that foreign company is not you. That was you who insisted in telling us that in the beginning, yeah, to say it's no longer my income. So it's not your tax, isn't it? However, you must have mighty influential friends, because we decided to be very, very generous. Usually we would never credit you a tax which you did not pay, but somebody else. However, in this particular situation, you will be allowed to claim a credit for the taxes paid already by the foreign company, but on your taxes which are due on the AFI. So, you must admit, we are mighty nice to you, aren't we? Because that's a breach of several principles of international taxation law, but we wanted to be nice to you. Because you're such a clever guy. I just wanted to give you the shock, and then, okay, let's smile, you get your credit, okay. Now Mr. Rich says, well, and furthermore, the foreign state charged me when I claimed or asked them for a dividend, then they charged a withholding tax on the dividend. And also that was a financial burden for me, and also for this I want to have some relief against double taxation. Naturally, here your fiscal officer says, well, here our answer depends just on what we are doing. For example, when we had chosen this former German approach that the dividend, no, if we do the present German approach, that the dividend remains fully taxable revenue, and later you get a free allowance or deduction to compensate for its tax effect, then you can just credit the foreign tax, the withholding tax on the German tax due on your dividend from the foreign company. Everything's fine, no special rule is needed. If, however, we had decided to stick to the former German approach that your dividend would be declared tax-free, then we would have a fundamental problem, because the foreign withholding tax could then be credited to the German tax on the dividend, and that would be zero, so that you had no tax relief effect. In this former situation, we were really generous. We allowed you to credit that withholding tax to the tax on the AFI. However, that's no longer needed in the new German approach, where the dividend revenue remains regularly taxable. So here, no special rule anymore. You can just tax the withholding tax to the tax on the dividend. However, if, for example, you are a German holding corporation, then your German tax on the dividend is regularly under 8b 0, and then you can, and other countries or other companies getting a dividend would have the same problem. So you are in the same situation as others. So to sum up all what we did until now, we do as if we do not tax the foreign income of your foreign company, but we grant you all the tax credits and behave in exactly the same way, that what comes out is exactly as if we did tax that foreign income as your income in your hands. So that's really requiring a good sense of humor. You might now draw the conclusion, well, if I shift 2 million to a foreign company abroad, and they tax it in the end as if I still had the 2 million, then they even credit all the foreign taxes, so the overall tax burden should be the same, so I have no problem. Indeed, that is, on the first side, the tax effect. And if you only look to the tax burden in total, it might be true. However, the whole system triggers a grave, enormous economic problem. Because in order to have the money to pay the tax for the AFI, you will have to force your company to pay out the dividends. And what if you do not have the power to force it to pay dividends? Then you have a huge problem. imagine you are the 40% shareholder of a foreign company. Someone else holds 60% of the shares. Now you are subjected to an AFI. However, your 60% shareholder is a foreigner or somebody else who does not have the problem, so he is not so much in desperate need of money, or he sits on a bulk of money already from other sources. So you say, I need a dividend. I have to pay, let's say, 800,000 taxes. I need dividends. Now, the other shareholder says, no, we are going to save the money in the company. So the shareholders' assembly is going to vote on dividend yes or no, and the assembly votes with 60% against 40% for no dividends this year. So you have to pay the 800,000 taxes on the AFI, you have no money, you have to organize and look for that money somewhere else from other sources, take up a bank credit for interest and things like that. So it's considerable liquidity drain and financial burden. Next year, same game. The dividend payment is again rejected with 60-40 of the votes. Again. You pay. Company gets rich, you get poorer and poorer, your bank gets more and more nervous when they see you. After some years, the 60% shareholder knocks on your door, smiles and says, I have a special offer to make. If you want to get rid of your shares, I'm willing to buy them for €1 or for €1,000 or at least for a laughable low price. And you will be forced to say yes, because otherwise, you know the game is going on. There will be constant taxes to pay, there is never money coming out, and so you will go bankrupt over these shares, although in theory they make you rich. So what does that mean for the behavior of anybody who is not fully mad? If there's any risk that a foreign company might end up as the cause for a CFC legislation for you, the shareholder, then no reasonable and prudent person could ever dare to buy shares in such a company. That means a prudent shareholder will never become a shareholder of any company which can ever or could ever in the future, in 3, 5 or 100 years, become subjected to the CFC legislation of your country and cause an AFI for you, the shareholder. So that's the first conclusion. Now the second conclusion is, when can you be sure that a foreign company indeed will never trigger such a CFC amount for you? And the answer is, you can never be sure. If they do not do anything which triggers a CFC legislation in your hands nowadays, you do not know, if you don't control the management, what they are going to do in 1, 2 or 3 years. You don't know if you trust the other 60% shareholders. You don't know if they sell to a brutal bastard in 2 years who then plays this game with you. And that leads to the conclusion, a prudent person never, under no circumstances, can risk to buy shares in a foreign company, if at least you cannot fully control what happens there. So you can buy a controlling majority, but nothing else in practice. And or you like to play with your wealth and your life, you are just a gambler, then you can do. Now, exactly this effect of a CFC tax regime creates a problem under the aspect of European Union law. The EU treaties guarantee all citizens, as you know, and all companies of an EU state the freedom of establishment. That means every enterprise owner has the right to hold a participation, among other activities, in a foreign country of the EU, in a company there. It not necessarily means the right only for a majority participation. The freedom of establishment also contains the right to become a shareholder with some influence, but a minority shareholder, let's say with 30% participation in a French company. Now CFC legislation makes that absolutely impossible. at least for prudent people. The free movement of capital is also granted. That includes the right that everybody in the EU can buy shares in any other company without influence on the decisions. And that's even granted with respect to companies of third countries. So in this field, there may be a few exceptions shielding tax law against criticism. However, they seem not to apply in our field of law, at least not completely. So that means you have CFC legislation, which, seen upon from an economic and prudent perspective, means you are practically never allowed to invest in a foreign company which you have not absolutely under control. And you have the EU treaties which say, yes, you have the absolute right to do exactly that. So we have an unavoidable conflict. Now, that makes it understandable that there have been court decisions of the European Court of Justice already, which said, first, that the existence of a CFC taxation is incompatible with the freedom of establishment. That it's even so incompatible that it can, in principle, not be justified. The only thing which they accepted is if somebody did not really use the freedom of establishment, but did just abuse it, so did not really set up a foreign enterprise in form of a company, but just used the foreign enterprise to do something completely artificial, so that the freedom of establishment, that one can say it has not even been used, actually. And the existence of CFC is also regarded in a new decision as incompatible, potentially at least, with the free movement of capital. Because buying a share in a foreign company might trigger CFC legislation that brings along unbearable bureaucratic consequences and a financial situation which might lead to grave losses or liquidity drains. So also here, the potential excuse or the way out is that the CFC legislation could be allowed for cases where the freedom of capital was not really used, but only used as a pretext for a tax avoidance scheme. So in that case, that would mean that there is no genuine investment of capital, but an investment was merely pretended in order to change your tax situation. So we have incompatibilities here which make the situation problematic. And that background explains why, as a consequence of that, nowadays the member states of the European Union very often restrict themselves to applying at least most rules for CFC legislation only on cases where the shareholder has a controlling majority about on the foreign company and not on other constellations. So these aspects make it recommendable to apply CFC rules under no circumstances to all foreign investments. Too complicated and too much negative impacts. So it's highly preferable for states only to apply such countermeasures against tax saving like CFC legislation in situations where a tax saving model at least could not be ruled out. So when you can at least have the suspicion it might be one. Extending a CFC legislation even to genuine investments might even do harm to the chances of your entrepreneurs in a foreign market. For example, if somebody invests in a genuine business corporation abroad and everybody pays their only 10% taxes, then everybody else has 1 million profit and can save 900,000 for reinvestment and can grow. Now, when we want our people investing there, they should have the same chances in competition as their local competitors. Then we would ruin that by lifting up the tax burden from 10% to, let's say, 50%, even before our people get the money. Then reinvestment would be strongly hindered, and so the profits of that foreign company should only be taxed with the local rate as long as the money is not paid out as dividends but used for reinvestment. So we should take great care that our trick with the invention of an additional fictitious income should only be applied to shareholders with regard to situations where one can at least suspect there might be some fishy things going around. So, where a state decides to establish such a CFC legislation, in principle, they still have to decide under which details they are going to apply it. So they will have to decide what can be suspicious enough to be attacked by such a CFC legislation. So the rules will have to decide which foreign tax level is too low. For example, if you have a home state tax level of 35% and you shift money to a foreign company with 40%, then it's clear this can't be no tax saving model. So this should already be ruled out. And the next thing is which activities in a foreign country are out of suspicion, which are automatically okay, and where can a suspicion be justified that perhaps this thing has only been done for tax purposes. So you need rules on that. And third, last but not least, from which participation onwards are you going to demand from shareholders that they pay these CFC taxes? So the foreign tax level, that's the first aspect. Naturally, as I already said, shifting income somewhere where it becomes more expensive is definitively not suspicious to be a tax saving model, so we don't need to bother about CFC constructions here. Sometimes it would also not be plausible if you shift activities to another country just for a difference of 0.5% or 1% or 2%. However, that depends on your judgment of how people in business would react, which efforts they would take to save 0.5% of tax, and so there is no overall answer for all states of the earth. Here, what we can say is a state will have to decide on the threshold which percentage of tax is too low, and then the concrete decision will rather be an arbitrary one. You will have to decide if you say my tax rate is 25% and even 24.99 is then too low because it's cheaper than my country, or if you say, okay, my tax rate is 50%, other countries are cheaper, so suspicious is only if another country has less than 30%. Well, that is just to decide for you as the legislator. However, if the tax proves to be lower, so too low, then there are still activities where it's clear that they have not been undertaken for tax saving purposes. The best example in my mind is mining activities. You do not open a coal mine in a foreign country because there are low taxes. You open the coal mine there because the coal is there. And so that's a clear thing that this kind of investment would be not suspicious. So any state must make a decision which activities will be regarded as automatically okay, even if they are undertaken in a state with a very low tax level. Technically, you can do this in two different kind of approaches. You can either make a list of activities which are okay and claim that all others are then suspicious, or you can make a list or general description of what is a passive or suspicious activity, and that's just again a matter of discretion, where a tax legislator can just decide on based on its own taste. Furthermore, you have to decide about the participation threshold, from which amount of shares can CFC legislation be expected to be applied. We said already under European Union law aspects, it's highly recommendable to restrict CFC legislation to majority participations or other constructions which ensure that you have control or together with closely related persons have control over the foreign company. However, one must see on the other side that if you say we only apply CFC legislation to, let's say, a German shareholder, if that German shareholder has a participation of higher than 50%, then the German makes a telephone call to a French friend and says, well, friend, here I have a problem. High taxes, I want to place a bit of my income into a foreign company. I am not allowed to have more than 50%. I heard that in your country there's the same situation, so let's found a company together, you 50, I 50, so nobody of us has a controlling majority. That might be a way to circumvent the application of CFC. Now, if you say, well, it's 33%, then 3 people would meet and say, let's look for number 4, and everybody gets 25%. So if you once set a concrete limit, then it's always possible to undercut it by just taking a bit more and organize this. Now, the more shareholders naturally exist, the lower is your influence on the dividend policy, and the higher is the risk that you are later suffering from that effect of getting AFIs and having no money to pay it, or that you shift your sources of income to a company where you only control 10% of the voting rights, so that with your former sources of income, 90% other shareholders can do things which you would have not liked. So we have here a trade-off. It is possible to circumvent thresholds, participation thresholds of 50%, of more than 50%, by just always being 1% below and taking one additional shareholder. However, the risk, the economic risk of such a maneuver gets higher and higher, and so a legislator will have to decide where it draws the line. So what you regard as still a plausible approach for a tax-saving model, and where you say a reasonable person would not risk that. Naturally, the 50-50% approach of the 2 friends in Germany and France, that might be easy. On the other hand, if you can say they agreed always to vote together, then there would be a partnership agreement, even an oral one, and then this partnership would hold a controlling majority. So whenever you have institutionalized mechanisms, you could, or you can make that plausible, then you could always bring forward, not the single shareholder, but a group of shareholders who organized their voting behavior in a certain way, have a controlling majority. So you might risk to limit CFC rules, at least in the frequent cases, to majority control cases. Well, in Germany, these rules, so the decisions which the legislator has to make in order to specify the details, can be found in the Außensteuergesetz, so-called Foreign Relations Tax Act, or sometimes officially even translated as External Relations Tax Act. Here in the current version, current year is when I speak now, 2023. Here in the current version, you find in paragraph 8.5 ASTG the low tax threshold set at 25%. So wherever 25% or more is paid as tax, there CFC legislation does not happen, because there one can reasonably assume that cannot be a tax-saving model, because that's expensive enough. Well, 8.1 gives then, if a low taxation is possible, 8.1 then gives an activity catalog. That means there you have a list of all activities which are deemed to be okay. If you do in a low-taxed country or in a high-tax country where this event is then lowly taxed, if you do something which does not show up on this list. It's regarded automatically as passive, so as suspicious, and will trigger a CFC legislation for the shareholder in the inland if the other conditions are fulfilled. These other conditions are usually then the participation threshold. 7.1 ASTG says in the new version it's only applicable, the general rules on CFC are only applicable if a shareholder controls a majority of the voting rights or another form of majority of the foreign company, or if that shareholder, together with closely related persons, controls the foreign company. So more than 50% of the shares usually. For foreign companies which have also income from capital investments, the threshold for participations is considerably lower because the financial markets are able and willing to organize models where many investors are associated or found and then caused to act together. So a threshold of 50%, let's say, for an institution, for a company which only invests in risk-free treasury bonds, that would easily provoke the financial markets to create some vehicles in form of a company where, let's say, every investor only has 20%, and so they could all save up money for a long time without paying taxes on these parts of their worldwide income. So here a lower threshold is set by German law. Mostly 1% is sufficient, but if the foreign company only has income from capital investments, then the threshold is even 0.x%. So even in the extreme case, a single share might be sufficient to trigger a CFC legislation. However, then only restricted to income from these capital investments. Well, that sounds rather complicated, and no surprise, in practice it is rather complicated. So in practice, people usually draw the conclusion from the existence of these rules that whenever something comes near the applicability of CFC legislation in practice, a tax advisor usually tells you, don't do it. The outcome will be you pay at least as many taxes as you would do in the inland. It's, however, a mass of expensive additional bureaucracy. So what about investing your money instead into some houses in the inland which you can sell after 20 years or 10 years for free of tax, or doing something different, or just holding these investments yourself instead via a foreign company? So in the final effect, these rules usually prevent their own applicability. Now, when it comes to using the tax differences between different states, the reaction is that people then concentrate on saving taxes by shifting active activities. So these, which are okay, where really something in reality goes on, which has an economic genuine character. So you place your steel factory no longer in the inland because here it's highly taxed and here we have high wages. No, you think of shifting it to a foreign country where the taxes are 1% and where the wages are only 10% of what is usual here. So in the course of time, the competition between states by tax rates for genuine investments has therefore steadily increased. And taxation has often become a major factor in the decision where to place new genuine investments. That leads, by the way, to a continuous pressure on states to lower their corporation tax rates in order to become more attractive, or in order to become attractive again in relation to all the other states. So with increasing internationalization and removal of obstacles for cross-border activities, the genuine activities were more and more influenced also by tax-driven ideas. States, however, wanted to restrict that influence of taxation on the choice of the location, because they didn't want to lose the revenue, and naturally they didn't want to be they didn't want investment decisions to be entirely tax-driven. So states have begun to think about extending mechanisms like CFC legislation to genuine activities abroad too. These ideas did not have any concrete outcome for a long time, because it was a huge step to say not only activities on paper, passive activities, shifting of patent rights, giving credits, all these things which mainly just happen on paper and have no influence on reality. These things were traditionally attacked by CFC legislation, and now states felt the need. We must also do something against the horrendous effects of tax competition when it comes to placing factories somewhere else, or to splitting up economic activities in a way that something that a part of an activity is done at the other end of the world, because there the tax is lower, and so we want to achieve a part of our profit at least there. That was a huge step. However, in 2017 the US first went forward and created a new additional CFC-like taxation regime, where they also wanted to tax the shareholder for profits from activities, genuine activities of their companies abroad. However, they didn't want to overdo it. So they said, the basic logic was now, when you invest into a foreign company and the foreign company has tangible assets, pieces of land, buildings, machines, and so, then we regard it as usually convincing if by these assets you can produce a yield of, let's say, 10%. I don't know which figure they really took, but a certain percentage is regarded as a decent and convincing and usual rentability of what you invested there. However, if you now manage to achieve a profit of 50% a yield of the invested capital there, of the invested tangible assets, then this is not convincing that this really comes from the rentability of these tangible assets. It seems to be that you shifted some intellectual property, some ideas, patent rights, knowledge or so there, and that you did the big money with that intellectual property. Now, an intellectual property is traditionally regarded as passive, and so they said, yeah, in that case we see that as something where undercover some passive income is included in the active activities. And so the new tax regime was constructed in a way that they said, we believe that up to, let's say, 10% of the value of the tangible assets is indeed profit from the tangible assets, and all the rest will lead to additional fictitious income for the shareholders. Because of the pretext which was chosen, this new tax regime was then labeled a tax on global, intellectual, low-taxed intangibles. Nicely abbreviated as GILTI, which alludes to how you would and should feel as a shareholder of such a company. Now, the excessive profits were then treated alike to any other CFC amount, although it's officially a different tax regime. So the taxes paid by the foreign company on these amounts were credited against your tax on these amounts. And in order to be not too harsh, certain free allowances were granted. So that's rather very abstract, so let me illustrate an example. Again, the concrete figures need not to be identical with what the Americans really do. I want to just show you the principle, how it works. So imagine we have a foreign company which earns 12 million. Now the book value or carrying amount of their tangible assets is, according to tax rules, 30 million. And we say we accept 10% as a reasonable yield of tangible assets. So we say these 3 million are explained. They have no passive character, so we deduct them from the profits of the foreign company. We end up with 9 million excessive profit, what is more than should be expected. So probably these are undercover created by intellectual property rights, which were not disclosed or things like that. That's just a pretext. So we just say these 9 million lead to additional fictitious income in theory for the investor. However, we want to be generous a bit, and so we grant a free allowance, and we say 1/3 of this amount is, again, the 1/3 is arbitrary now for the example. So a certain part of that fictitious income is free. So we just say 6 million excessive profit will lead to an AFI. Let's say shareholders' tax rate is 40%. Then that leads to a tax claim on the AFI at home of 2.4 million. You already paid, not you, but your company, 1.2 million. That can be credited, so remaining 1.2 million shall be paid by the shareholder at home. Why this? What's the outcome, and what's the sense of that free allowance? However, first, the AFI in principle leads to the effect that all the excessive profit is not taxed at the local low tax rate, but finally, and in the final effect, at your personal tax rate at home in your country. So no longer at 10%, but at 40%. The 3 million, which are reasonable and usual profit, are left at 10%, and all the rest is lifted up by the tax on the AFI to 40%. Now that's rather harsh if the foreign country is not really a low tax country. Let's say if they have 38%. Because that's evidently not real tax competition. There's no harm done, and it would overdo things to fight these as a kind of a tax haven. That is the reason of that free allowance. Up to 1/3 of the AFI is left free of tax. That means if you credit to the rest the full tax which the foreign company paid, then automatically, in cases where the foreign tax rate is higher than 2/3 of your own corporation tax rate, or of the own tax rate of the shareholder, the AFI leads to no additional tax claim in the country of residence of the shareholder. So that means the free allowance secures that a variation of, in our example here, up to 1/3 from the tax rate of your country does not lead to any, let's say, punishment taxes in form of a GILTI tax. However, if some guy invests and builds up a factory in a 1% state, well, then this is clear. You have a variation, a deviation of more than 1/3 in relation to your home state tax level. And so AFI, or here GILTI tax, leads to an AFI, and that compensates at least 2/3 of the difference, so that the tax advantage from going to another state is always effectively limited to 1/3 of your home state tax level, you cannot effectively now lower your tax burden more. Apart from the cases, and as far as you have that, let's say, 10% reasonable profit from the book values, but the bulk of the money will always be lifted up to at least 2/3 of your tax level at home. So that is basically a way to restrict the influence of tax competition and to ensure a kind of a minimum tax level worldwide, because for investors from America it makes no sense to invest in a 1% state and build a factory there, because they know in the end, let's say if their home state tax is 40%, then they know that in the end their outcome will be 26% effective tax burden. By the way, things have been modified. Together with the introduction of this, America lowered its tax to 21%. So if it's really 1/3, we would probably have a minimum tax of 14% ensured by the GILTI tax regime. And now imagine you are a country where Americans hugely invest, and until now you have a tax rate of 1%. Then you begin to think about it after a while, and you would probably think, why do I restrict myself to taking 1% if all my investors are lifted up to 14% tax level at home, and they also complain about the enormous amount of bureaucracy combined with all the procedures. So there is a strong incentive for tax havens to lift up this low tax rate of the moment to that what the others demand as a minimum tax rate to skip their GILTI regime. So that's relatively nice. This idea that by mechanisms like these you could indirectly force others to guarantee a minimum tax level, or to give them a brutal incentive to raise their taxes to a minimum and stop that race to the bottom of the tax rates worldwide. This idea was highly attractive to others when they read about that GILTI regime, and they began to debate if they couldn't ensure such a thing themselves. And one thought about, it should be done in a coordinated way, and that is why in the end the BEPS project of the OECD also began to talk about similar procedures. So basically, the idea of that American GILTI system paved the way to think about global measures to ensure a minimum taxation of income worldwide. The idea that tax competition, so that people, countries, were forced to lower continuously their corporation tax rates in order to remain attractive for foreign investors for active business. The idea that this could become, in the long run, very detrimental to the tax revenues of all states worldwide, and that it would probably lead to a race to the bottom, so that one state had to go down to 20% in order to become attractive or stay attractive, then the neighbor had to go down to 18 or to 10 in order to become attractive, and so that the 20% state then said, I don't get any investments anymore, and the present investments leave my country, so I have to go down to 12% or even 9%. So the idea that there a race to the bottom could happen, and a look back in history that a race to the bottom really had happened. In the 1980s, we had tax rates of 40, 50%, or more than 30% at least worldwide. And nowadays, the rates have dropped down considerably and everywhere. In order to say we must at least limit, if not reverse, that tendency, more and more countries were convinced to talk to each other to guarantee or to agree on a worldwide minimum corporation tax level. Now, it could have been easy to say, okay, then we make an agreement. every state has at least to take 15% corporation tax. However, then some tricksters would have set up a 50% rate and some free allowances and things like that. So that would work. Apart from that, every country would probably agree to such an agreement, apart from all these countries who lived from tax-saving models. So tax havens would not agree. So it was clear that a minimum tax level could only be achieved by using measures like the CFC system or the GILTI tax, things like that. Yeah. So more than 130 countries recently agreed that a new system must be created based on ideas like CFC and similar things, in order to make sure that at least huge multinational businesses will always be taxed as a minimum of 15% on all of their profits. And as it could not be made sure that all states of the earth would agree on levying 15% effectively, then it would be done everywhere where an enterprise, a subsidiary inside a multinational group, had money which would tax less than 15% in a country. Then this would lead to a kind of additional compensating tax, which was then charged by the fiscal authorities of the top holding of the group to the top holding, the so-called top-up tax. So if you had a subsidiary in a multinational group placed in a country where only 2% corporation tax were demanded, then the top holding at the highest level of the group would be charged with 13% on the profit of that subsidiary as a compensating additional tax. From the technique, I believe it's planned not to do it in form of an AFI, but just directly to charge them with the missing 13% on that amount. By the way, now it is possible, it would be the reasonable reaction of all multinational groups to place their top holdings then in one of the 70 states which do not take part in the new system. So additionally, there were rules that if the top-up tax could not be charged to the top-level holding in the group because, for example, the country of that company did not take part in or does not take part in the system, then the missing amount of taxes would be charged to and in any country where a subsidiary of the group is present. According to a formula, all subsidiaries of the group would have then to share a sufficient part in the missing top-up tax for the group. So that it is secured that if there is a multinational group, in the end, if they have at least one subsidiary in a country which takes part in the system, in the end, the complete group will be charged at a 15% level. So that seems to work seems to be very promising. However, the rules are extremely complicated, require coordination between the authorities, requires a huge amount of data which you need to acquire and to check in order to prove that the fiscal authorities that everything is done correctly. And so that's the reason why the new system is restricted to huge multinational groups, at least in the beginning. But what we can learn from all that, what we have seen here, is that when you have differences between the tax rules of the world, in the beginning of this chapter we once said, wherever there are differences in the tax treatment, then the taxpayer will always want the better treatment for himself. And now when you have 200 countries of the world, and a profit from a factory or a profit from interest or profit from a license fee is taxed here with 20%, and in another state it's taxed with 18%, you automatically have a difference. And so everybody will be keen on getting the better treatment, and that triggers tax planning. So every reasonable person who can do it with affordable costs will do it. That will become more and more. And now theory says the more intensified contacts are, the more difficult will it be to hold up these differences. And somewhere in the beginning of this lecture, in the first part somewhere, I told you something about stages of coordination between different jurisdictions. There might be first a simple coordination. Indeed, you find that in the tax field still very often treaties which say which rules of which country are to be applied to which events. However, then the more need arises, or after a while you get the need that also the rules get harmonized, that you get similar rules in similar countries. We have reached that stage, for example, in the contents of the DTT. They are all, or nearly all, based on the OECD Model Convention. The OECD gives rules which everybody voluntarily mostly takes over on how transfer prices have to be determined, and many other things. And now we have reached a level where more and more the need makes itself felt that the rules should be identical worldwide in taxation. So here we have first steps to say the tax rate must everywhere be at least 15%. Naturally, in the course of time, the 15% will still not be sufficient, or there will be additional impacts. Let's say if tax rates go up again to 60% in, let's say, 50 states worldwide, then these 50 states will not be able to live with a tax rate of 15% in other states. So we will have more and more forces which lead to more and more uniform rules worldwide. It's probably not what we will see in our lifetimes. However, if internationalization goes on, and under the aspect of global wealth, that's recommendable. If that goes on, then the need for uniform rules will get more. And we can already see the beginnings of that. That is highly fascinating as a background of what's going on in these aspects and areas here. On other countermeasures later in a new video. So first, enough for today. Recover well from watching this video, and till the next time, goodbye.